So good morning, ladies and gentlemen. Let me warmly welcome all of you to this panel discussion on economic outlook of Sri Lanka, particularly in the context of ongoing global crisis. We'll be touching upon the behavior of key economic indicators and the potential challenges that SMEs may face due to these challenging times. And also you could realign and recalibrate your strategies in these challenging times, how to navigate your businesses in time to come. We have the panelists. Let me introduce you the panelists for this panel discussion. We have Mr. Tharindu Abeyewardene, Chief Economist and Head of Research of Sampath Bank. We have Mr. Sanjay Aryavansha, Senior Economist of Sampath Bank, and Ms. Anita Varusavithana, Economist of Sampath Bank. So let me set the context for the panel discussion. First, all panelists will be taking us through with insights and foundational overview of the panel discussion. And then in the second round, we may take your questions and answer you. So to begin with, first of all, let me invite Anita for your insights.
Thank you, Roshan. So just to begin with, we'll start with a review of 2025 and what the economy was like at the end of the year. If we look at Sri Lanka's GDP, in 2022 post-crisis, we saw a decline in our GDP growth. And since then, there has been a steady recovery. This recovery has been consistent over the last few years and has helped the country start rebuilding its fundamentals of growth. We have seen an improvement in our revenue. We have seen an improvement in our external sector. However, there is also a lot further to go. So if we look at inflation, as you can see on the screen now, post-crisis inflation rates were fairly high and they have since come down. And more recently in 2025, inflation has remained under the central bank's target of 5%. And even looking closer into 2026, that continues to be the same. On interest rates, we have seen interest rates stabilizing around 8 to 9% in 2025. As you can see in this chart, the relationship between our reserves and our interest rates, essentially as our reserves decline, it puts further pressure on rates. And then as they build up again, we see that pressure on rates easing, which is what we can see happening in 2024 and 2025. And hopefully will continue in the future. This is the same concept on a similar view where we can see our PLR and the deposit rate, average weighted deposit rate, since the crisis coming up and then now moderating around 8 to 9%. Looking at private sector credit growth, post-crisis, we have seen private sector credit growth steadily picking up, surpassing credit granted to the government, which is a positive signal to the markets. We ended 2025 at about 25% credit growth, and that upward trend has continued as well. Looking at our current account surplus, we have had 3 years of a current account surplus from 2023 to 2025, but it's also notable to see that in our monthly figures for 2025, September and October, we had a deficit and then a smaller surplus in November and December. The reason for this can also be seen in the next slide, where we see our imports picking up in 2025 and in 2024, whereas our exports have not increased at that same percentage with that same velocity, and therefore there has been a pressure on the current account. Remittances and tourism have performed well. Remittances in particular have exceeded expectations, as you can see in the graph. Our tourism earnings has been performing well. However, there is further to go for us to meet what we can think of as a good benchmark for the country of the 2018 figures pre-crisis. And then looking at our international reserves, we can see the dip that happened in 2022 due to the crisis and then the recovery and steady accumulation of reserves since then. But it's important to note that if we look at the red bar that's indicated on the graph, which shows us where the IMF projections would have where the IMF has targeted our reserves to be. In 2025 and 2026, 2025, we were still below that target, and 2026, we have quite a bit to go to meet that. And then finally, on the exchange rate, there we have seen exchange rate depreciation. However, it has been within expectations. And again, here we can see the relationship between our international reserves and the rate of depreciation of our currency. So I'll close there and I'll hand over to Sanjay, who will give us some more insight on what is happening in the Middle East and the impacts that will have on Sri Lanka.
Okay, thanks. Thank you, Anita. So zooming out a little bit and going into what's happening in the Middle East. I think it started off in December, where there were massive anti-government protests because Iran was facing an economic crisis themselves. And with that, what happened was the Iranian security forces, it was reported that there were killings of these protesters, and there were indirect talks happening also. And on the 28th of February, US and Israel launched this Operation Epic Fury, where airstrikes killed off their supreme leader. And then what happened was Iran retaliated, and now we are in the third week of this war. And the critical issue that the international community is facing, especially in Asia, is the fact that the Strait of Hormuz, which is a choke point, is blockaded by Iranian security forces. And why is that important? Because 20% of liquid LNG, 20% of crude oil flows through that particular Strait of Hormuz, and about more than 80% of that oil is consumed. More than 80 to 90% of that crude oil is consumed by the Asian community. That is South Asia, Southeast Asia, East Asia, and Asia at large. So with this, we foresee three particular scenarios that can happen given the uncertainty of this. So there are three things, like I said. It could either end within this week or the next week, or it could go beyond a month or two, or it could be a prolonged war. It could go on for 3, 4, 6 months even. So under each of these scenarios, different things can take place. For example, if the war stops within this particular week, we see oil prices, Brent crude at around $104 a barrel. If the war stops within this week, we can see the markets reacting to it, and the prices could potentially come down. But if we see a prolonged war, markets will price in this premium, and we will see Brent crude up hovering above this $100 per barrel potentially. And why is that important? Because Sri Lanka, for example, in 2025, we spent about $4 billion of imports for our crude oil and refined oil importation. And a price increase of this particular barrel, a dollar price increase, results in that import bill going up. Not only the import bill, consumers themselves will feel it at the gas station itself when they're pumping petrol. The petrol prices will start going up, and we already see that. That's one aspect. Then there are other multiple aspects like it impacting exchange rate, interest rates. We'll talk about that in a little bit further. And even fertilizer imports, because fertilizer is an offshoot which comes from crude oil. So multiple aspects are impacted for countries like Sri Lanka in South Asia, as well as countries in the Asian region. So moving on, we also see a slight pickup in our AWPLR rates, but to isolate and say that is simply because of the war is a little bit difficult. It's too soon to tell that. But we see that in the next slide, which is on exchange rates. So we saw the exchange rate depreciating because as an impact of this particular war. It was hovering before the war, it was hovering around 309. Now it has gone depreciated. LKR against USD has depreciated to about 311. And we also see, apart from oil, tourism is a key sector. That's what we see here now. Last year, we got about $3.2 billion of tourism earnings to Sri Lanka, and about roughly over 4 million tourists came into Sri Lanka. But what we see here in this particular slide is during the month of March, you see a drop in the daily tourist numbers coming in. Why is that? Because about more than 40% of our tourists fly in through the Middle East. So most of these airports, like in Dubai, in Abu Dhabi, in Oman, are mostly, it's operational, but at a very low level. Flight cancellations has happened. So we see a drop because of that as well. And then moving on, what we see here, again, coming back to the oil story, like I said, so last year, on average for last year, the crude oil barrel price was about $68-69. So we saw about $4 billion going out for crude and refined oil importation. In 2024, was slightly higher. For the year, the average price of a crude oil barrel was about $78-79. And we saw the import bill was slightly high. It was about $4.4 billion. Now, right now, as I said before, the Brent crude oil price is hovering around $104 a barrel. And that's why we gave those three different scenarios. So if it's a prolonged war, we would see the oil price at a higher level. And that's what I said, that our import bill would also increase along with it, assuming that we import the same volume. So we import two types, crude oil and refined petroleum. And refined petroleum products consume about 70%, and the rest of the 30% roughly is about crude oil imports. So moving on, what are some of the impacts that the SME community could face from this? The most fundamental one would be that your input costs could go up because for obvious reasons, from your electricity costs to your obviously oil prices going up, that could have a direct impact on your input cost. And also we could potentially see that the demand side could also slowly start compressing. Why is that? Because people's disposable income would potentially reduce with oil prices going up, and discretionary spending could come down. So these are potential aspects that could happen if the war keeps prolonging. And of course, there are other aspects like supply chain disruptions. And of course, in terms of investor confidence, now we saw it even today. I think there was a small, about $50 million or $10 million sell-off from the treasury bonds. And that is also a potential aspect that could happen if this war prolongs. So, those are some of the aspects that we foresee, and we would look forward to any questions that you have. Thank you very much.
Yeah, so Tarandu, anything to add after those presentations of Tarandu?
So I think Anita covered the background leading up to the crisis, and Sanjay covered where it is now. So as Sanjay mentioned, if the crisis prolongs, we can expect the oil bill to be higher, even other commodity prices, because shipping supply disruption is very high. So all other commodity costs could also potentially go up. So all of that will have a negative impact on the inflation expectation. We were anyway thinking this year might trend upwards towards the 5% central bank target. So if there's a shock of this nature, then can potentially be even higher than that. And like what Anita mentioned, what we've seen historically is whenever something like this has happened, the risk premiums, and now more so because we are still recovering from the previous 2022 shock. So the pressure on interest rates, or the sensitivity of interest rates moving up, and even the exchange rate is that much higher. So therefore, the longer this continues, the greater will be the risk premiums, and therefore the movements on the interest rates and exchange rates. So, yeah.
Yeah. So now the audience, you can type in the chat if you have any questions. You can take a couple of questions also. We got 10 to 15 minutes more to continue this conversation. You're free to type in the chat and send us your questions if you have, and the panel is happy to answer. So until the question comes through us, let me also would like to touch on the reserve side of the country. So what kind of an impact that reserves may have due to this crisis situation?
So definitely negative, like what Sanjay mentioned, and even Anita mentioned. So our oil bill will definitely go up, and what we discussed is the price of crude oil. That's what we see. Reserved oil will be obviously more expensive, and shipping premiums costs will also be higher. So put all of that together, definitely our import costs for oil will be higher. And if shipping routes and shipping routes have been disrupted, so therefore other import costs will also go up. So naturally that will be a negative hit on the import side. usually when this kind of volatility happens, we see a slowdown in export proceeds coming through. Even remittances can slow down. So all that put together can put a temporary, and tourism, like what Sanjay mentioned, we see a dip already. All that put together can put pressure on the reserve position. So we were not in a, February month saw uptick in reserves, but last year in particular was a very slow growth for reserves for obvious reasons, because vehicle imports and all of those imports started coming in. So therefore the reserve accumulation slowed down. February month was a good month, although January was again not much. But now this will again be a negative. This month will likely be a negative on the reserve accumulation side. So that's probably the pressure that we are seeing on the currency as well. So I would think the longer this crisis continues, and when I say crisis, it's not the war itself. Even if the war has settled, if there is like sustained destruction on the oil infrastructure and all of that, then the possibility of oil staying higher for longer is greater. If that happens, then the impact is still the same. So therefore, we would hope for it to finish as soon as possible and for oil infrastructure to be intact. But if not, I think our reserve accumulation would be challenged.
Yes, thanks, Arun. So all in all, we don't see much of opportunities here, but more of threat in the situation. So Sanjay, would you add, do you see any opportunities? Because I heard that maybe transshipment and all have been slightly increased because Dubai side, the ports are not that operating well during the crisis. And even Hambantota and Colombo, there are a slight improvement on the transshipment side. But do you see at least a couple of opportunities where our people could, capitalize on?
So as you said, transshipment, definitely, yes, there is an opportunity there. But also there's a threat there as well. I'll explain that a little bit later. But what I also see is the FDIs that were in the Middle Eastern region, for example, in Dubai, in Abu Dhabi, in some of these countries. We have an opportunity to bring some of these investments to our country, even in sectors like BPO. Because some of these investors would foresee, if the war prolongs, that this is a region which there's uncertainty to it. So if there's uncertainty, investors would hesitate to invest. And therefore, Sri Lanka, if we pitch it correctly, I think we have an opportunity to bring some of these investments back to Colombo, to Sri Lanka, and some of these investments can go into some of the sectors as well, not just service sector, but in production, in plantations, in agriculture, in poultry, whatnot. Right? So these are some of the opportunities. But I was talking about the threat as well. So transshipment is an opportunity, but some of these ships that are passing by the ports are also offloading their cargo. And then we have issues in terms of at the port, there is constraints there because cargo is piling up. Because these ships were not meant to come to Sri Lanka, they were heading off to the Middle East. But that kind of a threat, it also exists. And what does that do in terms of clearing for border agencies like customs? Clearing cargo that is supposed to come in, there could be delays potentially. So that's another aspect that one should look at. Transshipment, yes, can improve, but also on the sideline, something like that also could happen.
But I think even like Sri Lanka probably operationalizing the spare capacity. We have a port and a airport at this in the south of Sri Lanka that is not probably fully utilized. So this is an opportunity for us to get it fully operationalized given the crisis. And like what Sanjay mentioned, because of that risk sentiment now in the Middle East, Sri Lanka seems a good natural neutral place for these logistics and both aviation and shipping to sort of focus on. This might give like a good opportunity for Sri Lankan Airlines restructuring also, because Sri Lanka as a whole could be viewed as a strategic destination in that case, given the disruption. So those are opportunities.
True. And there's a question from the audience. It's about our alignment towards IMF parameters due to this. So if the war, this Charitra Hettiarachchi, as we raise this question, if the war prolongs and given that we are currently behind IMF targets on reserves, what would this mean in terms of economic stability in the country? I would like to take this question, Pardo, yeah?
So I don't think that will be as far as the IMF program is concerned, I don't think that will be a major challenge, because IMF also would understand that this is beyond Sri Lanka's control. Yes, we were slightly behind that target, and they knew that in December as well. So I don't think that will be a major challenge. And even I think when the managing director visited Sri Lanka, she was saying, if there are external shocks, we will be ready to help and adjust the program accordingly. So I think this is such a shock. So I would think they'll be very flexible on that. But that doesn't say that we are not going to have a challenging period. We will have a challenging period, but there'll be flexibility on this. Anything to add?
Just because we had a shock in late November and December, as you all know, Cyclone Ditwa, and I think IMF also came in to support with an additional 200 million rapid financing program, in addition to the EFF particular program that we are going through of $330 million. So they came in with the $200 million. So I agree with Thaindu. If the IMF also foresees that this shock, this war is prolonged, it could be a shock on the system. There could be further support from IMF also. So that is something that could potentially be of support to Sri Lanka.
And a few more questions on the exchange rate. Since Anita touched on the exchange rate, can you please further elaborate on the impact on the exchange rate? Because there are a few more questions on the exchange rate.
Just overall in general, so we could expect with the reserve accumulation declining and additional pressure from imports, we could expect that to have some impact on the currency, and that would translate into a depreciation. I think anyway that is expected for this year. However, it would also be dependent on the extent to which the conflict, and like Thainu mentioned, not only the conflict, but the disruption to oil infrastructure, the disruption to the supply chains. If we see a fast recovery without a lot of infrastructure damage, then that effect would also reverse. So it would depend very much on how the next few weeks play out as well.
And let me take one more question. Mr. Shantananakara has posed a question. If we start importing through yuan, what would be your forecast for the USD, and what impact do you expect it to have on our other currency exchange rates?
So
first, is it a possibility, and then
it's possible in the sense that if the seller is willing to do, we also have a yuan swap, so we can utilize that. But so far, this is like a idea that has been floated. We don't know how. I at least to me, I don't know any country that has gone through with this proposal yet. But of course, if it happens, then naturally there will be some depreciation pressure on the USD if it happens at scale. Not if like a small country like Sri Lanka uses like 1 shipment, 2 shipments, or even 10 shipments in yuan, is not going to have a major impact on the US dollar. The dollar is appreciating mostly because of the risk sentiment that is there now. So therefore, I don't think it will have a major impact. But if major countries start trading in that, yes, then that could have a different impact.
I think it's a commercial transaction, a commercial aspect, but on top of that, there's a geopolitical aspect as well.
Yes,
when you're moving into these currencies.
Of course. Yeah.
Right, Sanjay, anything to add on that?
I was just also thinking of the 400 million barrels that were supposed to be released by the international community. I think out of the 400 million barrels, US is going to release about 170 of their strategic reserve oil. Why are they releasing? This is historically very high. Why are they doing that? To ensure that there is some sense of stability. But of course, that also being said, about 15 to 20 million barrels of oil flows through the Strait of Hormuz. So if you consider it's 20 million barrels of oil per day, 400 million is just for 20 days. So I think still the market if you look at the Brent crude prices, it's hovering above $100 per barrel. And even when this was announced, the prices didn't come down because, like Pandu mentioned, there is a risk sentiment in terms of oil infrastructure also being damaged. So that's another aspect I think I wanted to just bring in as well. Yeah.
And another question on the possible import restrictions. So are we seeing an import restriction coming into play with current situation or further escalation of the situation?
It's too early to tell, to be honest. But I think if it comes to that, if it comes to a major pressure on the existing reserves that we have, I think it will be a prudential measure. I mean, we've seen this during the previous crisis also, and later on it proved to be a good measure because I think the focus should be on getting essentials first because different people have different buying power. So if rather than 10 people going and buying very expensive something, a plane or a helicopter or something, I think it will be better for us to make sure that we have essentials, and these essentials also will go up. So we should plan right now based on our historical imports. We have, roughly about 3.8 months worth of reserves worth of 3.8 months of imports. But that was at that price. At this price, it will definitely come down. So we have to make sure that we can't run out of essentials. So we'll have to, I'm sure, I think it's too early still, but I'm sure the authorities will take, depending on how the crisis also pans out, take the right decisions.
And on the contrary, Kanadu, like apart from controlling, import restrictions are there. Like if we rigidly keep the interest rate down, and if we take out the reserves to control the exchange rates, then the problem will get worse.
Of course. I don't
because
think
we have such experiences.
We have such experiences. I don't think, based on such experiences and how they have gone before, I don't think it will happen this time. Definitely, they should allow the market forces to. These are automatic stabilizers. That's what we call it. Naturally, risk sentiment goes up, interest rate should go up, consumption and investment should slow down, exchange rate should go up, then the import demand should slow down. So all of that should be allowed to happen, not in a very disruptive way, but in an orderly way. Yeah.
All right. Any thoughts on the same lines, both of you, Anita and Sanjay? All right. We got some questions, but I think the time has come for us to make it an end. But let me take one more question. It's about freight forwarding industry. So they asking about what would be the impact of the freight forwarding industry because of this crisis.
Yeah. Temporarily, I think it will be very negative because of the disruption that Sanjay mentioned. Ports are congested, ships are not coming, they don't know how to reroute. I heard some people are talking about taking it to like other Middle Eastern areas and then through trucks to transport these goods to different other areas, because I think Jebel Ali is one of the biggest logistics hubs that's like almost closed. So it's disruption. We saw this happening during COVID also, where costs of shipping went up and all of that. But to what extent that will happen, I think will depend on how long this disruption continues. If the Middle Eastern situation, calms down fairly quickly, then this will be very short-lived. But if it prolongs, then in the short term, it will be a very difficult, challenging phase for freight forwarders. But if it persists, then they also probably can make money also. So, yeah.
Right. All right. So, we are just about to conclude the session. So, as the final round, let me give an opportunity equally to all three panelists for your conclusion remarks. Shall we start with Anita?
Sure. Thank you, Roshan. I think there isn't much to say. We've covered quite a bit today. But basically, things to keep an eye out is on the news. What are the indications being given by the global leaders? Does it seem like the crisis will prolong further? Are we seeing hits to infrastructure? And then thinking of how, as businesses, you can adapt. Are there supply chain alternatives? Are there ways in which you can mitigate risk from the exchange rate, for example? I think that's all I have to say, and I'll pass on to Tarindu or Sanjay.
Sanjay?
I think you can also just monitor on what other countries also be something that we couldn't talk about. Also, maybe looking at what Vietnam is, what measures are they taking, or Thailand, what measures are they taking, India, Pakistan, in terms of how they're reacting to this particular crisis, whether there are lessons to be learned of some of these policy measures that they're taking that could have a positive, if we do adopt some of these measures, whether it could have a positive impact on our economy, on our sectors, and our industries. Maybe something to also read up and look at continuously.
I think these kind of disruptions, now we got COVID in 2020, global event, this is another global event. We have climate related disruptions happening. So I think these kind of disruptions probably might be the norm going forward. So we've been through a few crises now, we've learned our lessons. So therefore, I think businesses also can, like what Anita and Sanjay mentioned, learn from whatever the global lessons, listen to the news, listen to or try to understand what's happening globally, and probably have very agile processes in the business also to adapt quickly. So that has been our success also. I mean, Sri Lanka recovered in record time after the 2022 crisis. That was driven by the strong policy measures that were put in place, plus the business resilience. So businesses somehow managed during that period, and they've learned the lessons. So all they have to do is put those lessons into practice and absorb whatever the new information that is there from whatever the source, and take decisions on the go to make sure that your businesses and your whatever the other activities stay proper during this volatile period. So that's what I think.
That's all from you. All right. So thank you very much. Let us conclude the panel discussion. And if you join in between, let me once again introduce who were there in the panel. We had Mr. Tarindu Abeyewardena, Chief Economist, Head of Research of Sampath Bank. And we had Mr. Sanjay Aryavansha, Senior Economist of Sampath Bank, and Ms. Anita Barasuvithana, Economist of Sampath Bank. So we believe that you have gained some insight from our discussion and definitely will apply in strategizing, in realigning your businesses to the current new normal situation. So with that, thank you very much for joining us, and thank you very much for your active engagement. We'll definitely see you in a similar session once again. Thank you very much and have a pleasant day.
Thank you.